Hello and welcome. I'm Jonathan Beale and this is the ASB Investment Podcast, a show that keeps you up to date on the market and helps you make smart choices with your investments. In this episode, Tennent-Brown and Aidan Vince from ASB talk about what COVID-19 has meant for the economy and share markets. We also chat about what we're seeing from our KiwiSaver and investment customers during this time. These are entirely our own views. It's not investment advice, but we know plenty of experts at ASB that'll be happy to chat if you need. Welcome to the podcast in a different booth. We're actually sitting in chairs. We're normally in high stools, so it's this is a lot more comfortable, Chris, isn't it?
Yeah, it's good.
And for those who maybe haven't heard the podcasts before, I think we did one about 2 weeks ago, and we like to jump on. And if there's stuff going on in the markets and in the economies, it's always good to be relevant and try and get some information out to our listeners. And I can't think of a more relevant time to actually be talking about what's going on and hopefully give some people some clarity and some views and maybe some advice on what they should be doing in these type of times. And to help us with that, we've got Aidan Vince, who's head of KiwiSaver at ASB. Welcome, Aidan.
Thank you. Welcome. Cheers, Jonathan.
Great to have you here. And Tennent-Brown, who's the senior wealth economist. Senior because there's grey hair on your face and the top of your head. So welcome, Chris.
Thank you.
So maybe let's just get into it. So I suppose if I go back a week, and it seems to be a week is a long time at the moment, is that we've seen sort of share markets be very volatile in up and down over the last week. We've had packages put together by governments here and abroad, and obviously we've seen the official cash rate be cut here, all in response to coronavirus. Maybe starting with you, Chris. Like, what's your take on what's going on and how are you feeling about things?
Well, firstly, this is it's a remarkable week just because so much has happened. OCR's been cut to what the Reserve Bank probably regards as the bottom setting, 0.25%, and the government's swung into action with a really big fiscal package. $12.1 billion is big, and so these are amazing things for me. You're right. I've got a bit of grey hair, so I have been around for a lot of events like this in the past, the global financial crisis, Asian crisis. I don't want to draw all the way back to 1987, but I could talk about that too. But what's really different with this is all happening at the front of the crisis. Often these measures come out during or sometimes too late. And if I think of things, we just got our official economic growth figures for 2019, and as at 31st of December, the economy was expanding at just over 2% per annum. Here we are, 2 months into the new year, and we've got a Reserve Bank that's cut rates. We've got these amazing measures, and the economy is, grinding to a halt because of coronavirus, and this is happening all around the world. It's just amazing how swiftly the economic outlook's changed, but also how swiftly policymakers have responded to it. It really is amazing.
I wanted to, I'm glad you made that point, Chris, because I suppose if you compare what's going on, and it is different to what we've seen before, everything seems to be different, but if you compare it to the global financial crisis, maybe the response then seemed to be take a lot more longer to actually happen, and this time it just seems to be so swift on what people and governments are actually doing. Is that a positive sign, or should we worry more about that?
I think that's really positive. If there's one thing we learnt in the global financial crisis is that monetary and fiscal policy works. If you've got an economy that's having a massive demand crunch, you swing into action and turn those taps on, and it will cushion the blow. The hard thing here, when we think about the actual heart of the problem, the virus, is the best way to deal with the virus that we're seeing around the world is to shut down economic activity. So these things like stay at home, self-isolate, these are things which cause the economy to grind to a halt, and but ultimately allow the recovery, which is containing the virus. So if we look at China, they put some incredibly hard measures on, but the daily rate of new cases is falling rapidly away, and so it seems like they've really contained it. But boy, that was hard on the economy. Now the big test is that they're opening up factories and going back to work. So this is where the unusual bit is, that the cure, if you like, is actually part of the problem for the economy. So that's the bit that's new for me.
And why? I think people, and if you look at the media, it's share markets constantly in the news, and we are seeing some wild swings. One day down 9%, then up 9% the next day, and then down and up. It's. But what's actually driving that? Because the underlying, a lot of the firms that are affected are still making what they make, and people are buying what they make. Why does it move around so much?
Yeah, well, that's really interesting, and there's some things which make sense. And for example, the aviation industry, the outlook is drastically changing in the near term, and I know firsthand because my partner is a flight attendant. There's no flights, there's no work for her, and take that up to the scale of the company. This is obviously going to have a massive impact on their revenue, and therefore their valuation. There's other things. Companies that are just going to be working the same as they always do, and in the near term they might have demand shocks because people change their habits. Think of something like Coca-Cola. We're probably still going to drink Coca-Cola, but not in a bar or a restaurant, maybe at the barbecue at home or something like that. So those companies are quite near-term shocks, but they still get caught up in the waves of selling. And buying too. I mean, we've seen that the share market overall is down, in New Zealand's case about 25%, in US case 30%. But we've seen some down days where it's gone down 9%, and then the next day it's gone up by a similar amount. Now, those companies aren't changing in that magnitude over that time. That is just a function of people buying with enthusiasm or selling with panic. Likewise, in the government bond market, the New Zealand government is in an amazing position, yet government bond yields are whipping around all over the place as people buy bonds on one day and sell them on other days. So it's very hard to look through that noise, but it's worth focusing on. If we saw the same thing in the global financial crisis, and most of those big companies whose share prices were all over the place are still there today, but what people are prepared to pay for them on any given day changes a lot when you get this sort of tension in the markets.
And maybe a good time to bring you in, Aidan. So we've seen volatility in markets, and KiwiSaver is probably one of the investment product that most of the people who are listening are probably in or have got or certainly know about. And you've been looking after KiwiSaver for quite a while at ASB. What are sort of the majority of our customers doing at the moment in this sort of uncertain time?
Yeah, look, this is going to be the first experience for many investors of volatility. They've been in KiwiSaver. It's probably their first exposure to share markets and things like that. Even if they joined KiwiSaver at the start in 2007, the GFC hit, but balances were small and it wouldn't have been noticed by most New Zealanders, lots of New Zealanders, apart from obviously the flow-on effects. So from a KiwiSaver, a managed fund investment point of view, this starts to be the first time that people are really starting to experience this volatility, and it's been dramatic. The pleasing thing is that most people aren't doing anything. And that might seem a bit back the front, but that gives me confidence that investors appreciate they're focused on their goal, their investment time frame, and are confident that actually riding out the volatility is the right strategy. But it stresses that importance. It's
a good point, though, that this is be the first time that a lot of people experience this, and that it's. I think sometimes it's really easy or even cliche to go, it's long term and, what's your risk tolerance and those types of things. But it is uncertain for people, and we need to be aware that this is uncertain. This is people are looking at their balance and it's going down in some cases. But what are some of the things that you're hearing customers say, or and how do we respond to some of the questions?
Yeah, so I'm one of those people you're talking about, Jonathan. I look at my balance and go, oh, this is uncomfortable. It's not a feeling, and you can understand why people are uncomfortable through it. The thing that people are asking is, what's going on? Where's my money gone? There's this perception that they've lost money, something's gone, something fishy is happening. Yeah. Once you can help people understand, well, this is what's going on. Share markets are having some tough times. The unit price is decreasing through this period, and that flows through to what you see on your balance. A message and the help that we're giving customers through this period is going, but let's make sure you're in the right fund for your investment time frame. If we are recommending somebody a cash fund today, it's because they're looking to buy a house in the next year or two. We're recommending cash fund. We're not recommending cash fund because markets have had a really tough time. We would have recommended cash fund for that same investor 12 months ago when markets were roaring. Yeah. Equally, if you've got a longer time frame, like me, I can't touch my KiwiSaver for 20 plus years. Growth fund is what we're recommending. Now, that's a weird thing for people to get when the markets are doing this, but we're focused on the long time frame. You want to have lots of exposure to shares, and hopefully as through this sort of education session, people will also start to understand that shares are actually cheaper at the moment than they were a month ago.
Well, let's come on to that, because I think one of the things that's very different today to when I think about, I don't have as much grey hair as Chris. I don't have much hair. That's probably I knew you were going to say that. But the fact that when I started in financial services, if someone wanted a value of their investment, they would phone me up and I would say, can I have a value of my investment? And my answer would be, yes, we can do that for you. It'll take about 6 weeks to put it together for you. And people were fine with that. But that's what it was like years and years ago. Today you can see it on your phone and it's jumping around every single day. But I think your point is the value's moving up and down, but actually the value's made up of the number of units you've got times a price, and the number of units actually is still there.
The same.
And it's going up if you put more money in.
Exactly. The price of each of those units is actually 20% cheaper than it was last month. You can access Growth Fund, for example, at 20% discount on a month ago. And once people get that, they start to see it in a different light and go, oh, okay, so actually if it's long-term money and it's a long-term investment, then should I be adding some money? And the conversation changes.
So let's give it a scenario. So I'm sort of between the age, I know, I'm making this up, it's not me, but I'm the age of, say, 25 and
it's not you, no.
40, thank you. I've got my first home, so I can't exit for that. And so actually KiwiSaver is now for my retirement.
Yes.
I'm in the growth fund.
Yes.
What would you be recommending that I would do?
I would be firstly recommending you stick with your growth fund. You might not like the downward movements that are happening at the moment, and I understand it. I'm not liking watching it either, but I'm focused on the long term. So stick with what you're doing. But actually, it's a good chance to go, well, actually, what would happen if I start increasing my contributions? Not because markets are down, but actually, it's a good chance to reevaluate. Well, how am I tracking for the future? What is the difference of saving 4% of my pay instead of 3%? Also, you've got that bonus at the moment that 1% is going to be getting a bit more into the fund, which you get the uplift on the upside.
And you would recommended the growth fund previously because I've got a long time to retire.
Exactly right. So the recommendation of the growth fund today is no different to what we would have been recommending last year. The recommendation isn't driven off the fact that markets had a great run last year and so you should get into growth and now you shouldn't get into growth. We're recommending growth fund because you've got a long time frame. You want to have lots of exposure to shares, 80% plus in the growth fund. Yes, it's going to have periods where it goes up and down, but because it's a long-term investment that you're focused on and that's what your goal is, you've got the time to ride it.
It's a very different mindset, though, isn't it, to start thinking about actually what I want in my KiwiSaver is lots of units.
Yes.
Rather than the balance to go up. And the more units I get, the price is always going to go up and down over 20, 30 years, but the unit thing is really what I want. The more units I get times by the price, I've got a larger balance.
It's quite perverse, and you'd almost, in a perfect world, the unit price would keep coming down, drops down to 1 cent, and we can keep buying lots of units at 1 cent, and then
it jumps up.
When it jumps up just before when I want to start using it, it rockets away again. Now that's not going to happen. That's where people start wanting to get into this concept of trying to time the market and make choices based off what the markets are doing.
Yeah, and that's a real. That's one of the things that I see that's pretty scary when I'm looking at what people are writing about and blogging about and that sort of stuff. Is that this idea that, hey, I'm gonna get out, and when the coast's clear, I'm gonna get back in. And I've done this for a long time now, and I just know there's no smoke signals that come out to say, hey, it's all gonna be well and good now. I don't come into work thinking, hey, we're going to have a 9% up day today or a 9% down day for share markets. They're just volatile at times like this. And I look back to in the global financial crisis, people could only see things moving in one direction. House prices are falling, share markets are falling. And it came to a little bit of a surprise as everyone when markets had turned around. And it's interesting to see in hindsight what some of those predicting points were for turnarounds or events that happened around the same time in the global financial crisis, which really related to the banking system. One of the things was when banks started to report reasonable results. But it wasn't like there was a big email that went out or the newspapers were saying, hey, everything's safe now, get back into your investments. The movement in share price recovery was already well underway once those sort of good news stories were flowing out, and this will be the same at the moment. Only people can only see bad news, and we're seeing this massive volatility, but it's hard to pick those turning points. And when I look at it, one of the differences I think between now and the global financial crisis was for KiwiSavers, people's balances were small and they were contributing, and that was making their overall thing go up, whereas now their balances are quite large. So these movements are very visible. But the other thing which has changed drastically over the years is the social media presence. We just get so much information now. And a lot of it, when it comes to making long-term investment decisions, is completely useless. The day-to-day stuff we see on Facebook and that sort of stuff is often very alarming, but not very useful when you're trying to make well-thought-out investment strategies. And so that doesn't help either. To Jonathan's point, at the start of my career, pricing wasn't something you got on your phone because we actually didn't have cell phones, and it would take weeks often for the sorts of news that people are reading about every single moment of the day at the moment to get through to you, and that makes life tough for investors that are a little bit edgy.
And
anyway.
you've talked about that on previous podcasts about let's stick to the facts. And I've said a number of times that I do regrettably have the Daily Mail app on my phone, and actually deleted it last week because I was just getting so annoyed about the sort of you're just trying to scare people, and it's just not unhelpful actually. So looking through actually what's the facts of it, your KiwiSaver balance isn't going to go to zero. Mm-hmm. The unit price might go down or up, but your number of units is there, and when the share markets go back up, then the value of your KiwiSaver is going to go up. And a lot of people actually in New Zealand, most of their money probably isn't actually even in share markets. It's actually in fixed interest and bonds. And it almost seems that's the boring part of investing, but actually that's quite a relevant point in a diversified or a well spread portfolio, isn't it, Chris?
Oh, well, during the last 2 years when share markets have been going so well, one of the common questions I've had is, why do we have money tied up in these bond funds? They're just a drag on performance. And at times like now, owning the government bonds of New Zealand, the US, other things which are smoothing out the returns. And that's what diversification's all about. And but even the value of those things gets whipped around a little bit at times like now. And it's when you look at all the information that's burbling around out there, none of it's too helpful when it comes to what to do with a well-thought-out investment strategy. And like Aidan said, it's kind of reassuring when the bulk of people are just sticking with those well-thought-out strategies rather than chopping and changing.
Mm. And then if, say, I was in a conservative fund, Aidan, what sort of... how would that have been impacted over the last few weeks? What would my balance gone down by?
The conservative fund, so we are talking sort of 5% over a month. By comparison, growth fund is 20%. So you see that shift. Conservative fund got far more invested in bonds and cash and term deposits and the like, far more less impacted. Yeah. But it also shows you the drag of shares. Yeah. Now, obviously, conservative fund, the flip side of that is you're not getting that uplift over the longer term. Yeah. So it's that message you're getting in the fund for your time frame. Conservative fund is great, we think, for someone looking to use their money in 2-3 years. Yep.
And I know you haven't got a crystal ball, Chris, but you're an economist, so you're always looking forward and what might happen. What from the economics department at ASB, what are some of the things that you're actually doing, and what sort of some of the things that you're really thinking about? Yeah,
well, the first thing for us is that over the course of 6 weeks, this has shifted from being a short, sharp shock to something that's going to impact us for longer. And I think people know the reasons why that is, as it's spread from being something that we thought was happening offshore to something that's impacting the entire world. What we're really doing is trying to come up with ideas about what good responses are So helping people understand things like the government's support for the economy, what the lower official cash rate means and what they should expect with borrowing costs, term deposit rates and that sort of thing. In terms of our forecasts, we also try and put things into perspective. So we will see an economic contraction with this. That's unavoidable no matter what the government does or what the Reserve Bank does. What we are encouraged by is policy, like we're saying, that's going to cushion the blow, and we're really encouraging people to do the basics right. So be it something like this, how to think about investments and stick to your long-term investment plans. For businesses, what are the things to watch? For me as an economist, the things that I look for signs of encouragement beyond those responses is the actual nature of the disease itself. And this isn't reading my Facebook feed. This is actually getting onto good information sites to see how well the containment efforts are going. And this is where it's a real interesting thing, is when you look at the areas where you go, wow, you've looked to be really containing this, you're also seeing big impact on the actual economy. So this is sort of saying what happened in China, what did they do, versus what's going on in Italy, why are they having such big outbreaks there, and trying to work out where New Zealand sits in all of that. So really to sum it up, just trying to look at information that I think is relevant to the businesses we deal with and relevant to our investors. And when it comes to this volatility that we're seeing in markets, just trying to put some context around it. And most people probably don't realise or think about it too much now that they've actually been through periods like this if they've been invested since KiwiSaver started, for example. They went through the global financial crisis. They went through the European debt crisis. They went through the upheavals in 2018. It just becomes more and more apparent as your balances get bigger and bigger.
Thank you for that. So maybe I might just call it to a halt there. But hey, thanks very much, both of you, Aidan, for your first time in the booth, and Chris, as always. Really helpful and sort of clear sort of advice and guidance that you've given around sort of, if it's long term, stick to your long term plan, sort of look through the noise and actually look at the facts and stuff around actually what is going on. Appreciate it is unnerving, but actually if you, I think in the future we'll look back and go, oh, remember that really crazy time and stuff, and what happened. But I think if we stick to actually the basics around investing, which is easy to say and sometimes it's much harder to do, but the discipline around your long term and actually being in the right profile and not trying to time market, actually in the long term will be a real benefit to investors, I think, not just here but around the world. But hey, thanks very much, guys, as always. Thanks for that, and speak to you again soon.
Thank you.
Okay, thank you.
Thanks for joining us today on the ASB Investment Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on future shows, please fire your suggestions through to podcasts@asb.co.nz.